Most people with an emergency fund have one problem they've never been told about. Not too little saved, not the wrong bank, something deeper, something structural. And the worst part, it only becomes visible the moment it fails. Here's a scenario that plays out for real families every year: 4 months of expenses saved, high-yield savings account, doing everything the advice told you to do. Then month 1, job loss, the fund absorbs it. Month 2, the car breaks down, repair bill arrives. The fund absorbs that too. Month 3, a medical bill from something that happened in month 1. And you're sitting there with almost nothing left, still without income, realizing that 3 separate emergencies, each manageable on its own, just drained a fund you spent years building in under 90 days. You didn't save wrong, you saved without structure. And that distinction, the one most financial advice skips entirely, is exactly what this video is about. Because the fix isn't saving more. The fix costs nothing extra. It's how you organize what you already have. Financial planners have a term for that pattern: a stacked emergency, 3 separate crises hitting in sequence inside a single quarter. Job loss, then car repair, then medical bill, or roof damage, then job reduction, then unexpected travel. The specific events vary, the sequence doesn't. And the reason standard emergency fund advice fails against stacked emergencies is that it was never built for them. Save 3 to 6 months, put it somewhere safe, treats your fund like a single tank of water. But stacked emergencies don't arrive like a single flood. They arrive like 3 separate punctures at different depths at different times. What I'm going to show you is a structure called the 3-tier safety method. 3 layers, each one serving a specific purpose, each one intact when the others are under pressure. By the end of this video, you'll know exactly how to build it, and more importantly, you'll understand why the fund you have right now may be one crisis away from failing you on the 3rd hit. Here's what makes this urgent. If your entire emergency fund, every dollar you've saved, sits in a single account right now, it has no internal barriers, no separation, no compartments. That means every withdrawal, regardless of the emergency type or the timeline, draws from the same reservoir that was supposed to carry you through the worst 6 months of your life. A car repair in month 2 doesn't know you're still in the middle of a job search, it just draws. And then the fund that was supposed to last 6 months in practice lasts 3, not because you spent recklessly, because a single account emergency fund has exactly one weakness, and stacked emergencies find it every time. Naval engineers spent decades learning this exact lesson. Early ships were built with a single continuous hull. One breach, water rushes in without resistance, no barrier to stop at, no structure to contain the damage. The vessel sinks. Modern ships are designed with watertight compartments, sealed sections that prevent flooding in one area from immediately compromising the others. The Titanic's actual design failure wasn't its size. It wasn't the number of lifeboats. The compartments were connected at the top. One breach led to water spilling into the next compartment, then the next. The flooding had no place to stop. A ship built with properly sealed compartments survives the kind of damage that sank the Titanic, not because the compartments prevent the breach, but because they contain it. Your emergency fund is the ship. Right now, it has one compartment, and the question worth asking before the next financial emergency arrives is not "do I have enough?" It's "where does the flooding stop?" The 3-tier safety method builds 3 watertight compartments into your emergency savings. Each one has a specific depth, a specific function, and a specific set of instruments. And they activate in sequence: Tier 1 first, Tier 2 only if Tier 1 depletes, Tier 3 only in a prolonged crisis. Tier 1 is your immediate access layer. 1 to 2 months of essential monthly expenses, rent or mortgage, utilities, groceries, insurance, minimum debt payments. This money lives in a high-yield savings account or money market account with same-day access. FDIC-insured, no lockup period, currently earning competitive yield near or above the current inflation rate. This is the account you reach without hesitation when the car breaks down at 7 a.m. or the medical bill arrives on a Friday. You don't ration Tier 1, you don't protect it, it exists to be spent. Its only function is to eliminate the 72-hour panic window, the moment when most people make the financial decisions they spend years recovering from: the emergency credit card charge at 24% APR, the early retirement withdrawal, the loan from family. Tier 1 ends that moment before it begins. It absorbs the first puncture. The second compartment stays sealed. Now here's what standard advice gets exactly wrong. It assumes the emergency ends. It builds a fund for a single event: 1 job loss, 1 repair, 1 medical bill, and implicitly assumes the next crisis will wait until you've recovered. The data says otherwise. The average job search in today's market runs 16 to 20 weeks. That's 4 to 5 months of runway before income resumes, before you account for the car repair in month 2 or the follow-up medical appointment in month 3. The stacked emergency is not an outlier. It is the realistic scenario for anyone going through a major financial disruption. And the emergency fund sized for a single event, held in a single account, predictably runs dry before the disruption resolves. This is the part of the conversation that most financial advice quietly skips, not because it's false, but because your emergency fund structure is broken is a harder message to sell than save 3 to 6 months. One is actionable in a weekend. The other requires actually rethinking something you thought was already solved. Tier 2 is your medium-term buffer, 1 to 2 additional months of expenses held separately in a no-penalty CD or a money market fund. This account accepts slightly less than instant access, 2 to 3 business days to transfer, not same day, and that small friction is the point. When you've been in a job search for 6 weeks, you know it. You're not blindsided by the need to access Tier 2. You plan the transfer 2 days in advance and the money arrives before you need it. The urgency that Tier 1 was built to absorb gone. Tier 2 handles a different type of emergency, the one that extends past 30 days, the job search stretching into month 2, the medical situation with follow-up costs, the home repair requiring staged payments. And because Tier 2 accepts slightly less accessibility, it earns slightly more, not dramatically more in any given month. But the differential compounds across years, across the time when you're not in a crisis and these dollars are sitting in the account growing. You don't sacrifice liquidity when you need it. You earn more during the years you don't. Now we reach the layer that almost no one builds and the one that protects what the other 2 layers can't. There's a question that standard emergency fund advice never asks. What happens to the purchasing power of your savings during the years between emergencies? You build 4 months of savings, you hold it. Inflation runs at 3%. In year 1, the erosion is small. In year 3, it's measurable. In year 5, that 4-month fund covers noticeably less than it did when you built it, and you never noticed, because the number in your account stayed the same. The account said secured. The purchasing power said something quieter. This is how emergency funds silently fail the people who built them carefully, not in a crisis, between crises, dollar by dollar, year by year, in the gap between what the account earns and what inflation takes. This is the specific vulnerability Tier 3 addresses. Your capital preservation layer, the portion of your emergency savings beyond what Tiers 1 and 2 hold, belongs in instruments designed to protect real value, Treasury bills, short-term CDs or I-bonds, government-backed or FDIC-insured, principal guaranteed, currently yielding between 4 and 4.5%, significantly above what standard savings accounts pay. This isn't an investment strategy. It isn't speculation. It is the mechanism by which the deepest layer of your financial security holds its real value across time. Every dollar in Tier 3 is worth just as much in year 4 as it was in year 1. The inflation that quietly erodes idle cash cannot reach it. These are the funds you never want to touch. But in the event of a prolonged emergency, a 6-month disruption, a significant medical situation, when you finally access Tier 3, you're drawing from capital that protected itself while it waited. That is the difference between an emergency fund and a 3-tier safety method. One holds money, the other holds value. Here's what the redistribution looks like in practice. If you currently have 4 months of expenses in a single high-yield savings account, the shift requires no new savings, only a reallocation. 1.5 months stays in your existing account as Tier 1, immediate same-day access. 1.5 months moves to a no-penalty CD or money market fund as Tier 2, 2 to 3 business days earning more. The remaining month and every new contribution going forward builds your Tier 3 in Treasury bills or short-term I-bonds. Capital preserved, inflation protected, waiting. The stacked emergency that would have drained your entire fund in 90 days now activates each layer in sequence. Tier 1 absorbs the first hit. Tier 2 absorbs the extended disruption. Tier 3 remains sealed unless the first 2 fail simultaneously. For most households in most financial emergencies, Tier 3 never opens. It just grows protected from inflation until the day it's needed. And on that day, it will be worth exactly as much as the day you built it. Your emergency fund isn't just a number, it's a structure. And the structure is the part that decides whether 3 consecutive crises drain you to zero or whether the third hit finds a sealed compartment still waiting.